final round of the bootcamp from subsurface to strategy. We have had a couple of weeks, reservoir engineering, petroleum technology, uh, petrophysics, geology, and the likes. And we are going into the week for the petroleum economics. So today's today's technical session would be for petroleum economics. It will be handled by our speaker who will introduce really soon. And for myself, I am Israel Bassi. I'm a well engineer with ExxonMobil. I previously have worked as a petroleum economist, which makes me really interested in petroleum economics and the business side of petroleum engineering. I'm a graduate of petroleum engineering, first degree and master's from IPS. Currently, it's great to have to moderate this session. Looking forward to really learning from our speaker for today. And we know the drill, basically. We get to listen to our speaker. We get to look at what is expected from us for this week. And then we'll get back together to review and get our project done. So I really do believe today's session would be worthwhile, and I hope everyone is able to gain from it. So once again, we're coming into week 5, Petroleum Economics, and our speaker for today is Dr. Austin Uku Esquire. He's a consultant petroleum engineer and a lecturer with over 15 years experience in oil and gas, asset management and administration. He holds a PhD in petroleum reservoir engineering with domain knowledge in reservoir property modeling, field development planning, decision-based integrated reservoir modeling, resource volume estimation, reporting, petroleum economics, OPEC gas condensate and auditing procedure, and computational mathematics. Really rich there. He's the founder and CEO of Gyrocake Energy Services Limited, a company providing oil and gas technical services, primarily in oil and gas asset management. Dr. Austin also holds a Bachelor of Laws and was called to the Nigerian bar and enrolled into the Supreme Court with enrollment number SCN 124418 and practice as a barrister and solicitor. His core practice areas are energy law, corporate practice, tax consultancy, intellectual property law, and regulatory compliance. He's the lead solicitor of Austin Ukwan and Co., a law firm with special interest in rendering legal services with optimum client satisfaction as its basic focus. He's a registered engineer with Coren, and he's a member of SP, NSC, NBA, and NREP. Now, this is a profile that just intimidates you no matter what level you are on. And it's really amazing for us to have someone like this. On this note, I would like to welcome Dr. Austin to the call. If you can share your screen here with us, Dr. Austin. Would like you to share your screen. Would like you to just come up and share your screen and get the technical session started. Dr. Austin.
All right, thank you, my brother. Please, just some seconds. Let me get this thing up,
No
please.
problem, sir. Yeah.
Okay, are we okay here? Please, can you hear me?
Yeah, yes, sir. Yeah, I can hear you, sir. You're
We can hear
straight.
you,
Yeah.
sir.
Okay,
Yep.
all right. So, my idea is to walk you through oil and gas asset management economics, or what people call petroleum economics. Now,
Is it possible to have your screen on slideshow? Thank you very much.
all right. So, for you to build proper economics, you need certain ideas. First of all, you have to build your cost allocations. Very important because oftentimes when we do our cost, we forget certain elements that some of them are capital expenditures, some of them are operating expenditures, and some are actually deductible tax deductible, some are not tax deductible. So it's important for us to understand the basis of cost allocation in economic building. So if we build a cost, all of it will subtract and say, oh, this is what we're going to pay tax. That would be very wrong. So we need to understand how costs are being allocated. So you know the type of cost where it should stay because it's important. You can sometimes people will compute as simple thing again because you find out that you increase your tax by just simply taking non-deductibles to deductibles or deductible to non-deductibles. It's as simple as that. So after you do your cost allocation, the next thing you have to move on to again is what your fiscal calculation, which means you're going to calculate the tax. Because for you to do business in Nigeria or any country, the host country must know what value you're adding to that host country. What value, and the value you add comes in terms of tax, royalty, and all other payments you make to the government. In terms of maybe it can be social development like employment, it could be economic development like tax or other financial development like tax. So once you're able to execute, understand the proper tax you're going to pay, and it's not by guess, it's not by making assumptions. Tax policy, tax regimes are actually by law. So if you're going to pay a tax of 30% on something, it's 30%. So you cannot assume it to be 20% of anything and then think the model is right. No. So after we deal with fiscal calculation, we look at contract analysis. So in contract analysis, we now if there are different kind of contract because when a company comes to Nigeria, he has to enter a contract with the host country. So when they enter a contract, the contract defines again how they are going to relate, who does what, and how they are going to share what comes out of the business. So after cost analysis, we now go to project analysis and what evaluation. So we now look whether that project is actually financially viable or not viable. And then finally here I'll do simple case study to analyze exactly what I've said here. So these are procedure we're going to follow. So one objective of economic analysis, one is to create economic and financial model of a project for use in estimating the key performance and investment indicators such as cash flow projections and check robustness against model inputs. So that's the major thing we're going to do here to create economic and financial model of a project, and we use that model to estimate key performance indicators, performance and investment indicators, and such as cash flow, NPV, all those things, and with those things we can say, oh, this project is viable or is not viable. And two is to assess and determine if the project is profitable for the level of investment to be put into it. Because if someone can say like big company like the Shell, Mobil, big companies, due to the investment they're going to put into a project, that project may not be viable. But a smaller company can invest a certain amount of money and that project may be viable. And that comes to the idea of what Nigerian people usually call national field. That because the big companies feel that their investment in that project may not be economically valuable to them, so a smaller company can invest and produce and make and is viable. So what am I saying here is that a project that is economically viable for one company may not be economically viable for another company. So it is not a one-way street that if it's viable for this company, it's viable for that company. No, a company can say that this profit margin here is not viable for me. So when we do this, we assess whether for that level of initial investment, is that project viable or not. Two, we are going to assess and determine whether that project is capable of sufficient to generate enough money, enough revenue to pay back its debt. Oftentimes when we do business, we need to incur some debt to that business. You need to project whether that investment is able to pay for the debt that have been incurred over a certain number of time. You know that if your loan, if your debt is extended more than 10 years, depending on the rate, it could be more. Let's say you're paying something like 2% per annum. In 10 years, you're paying that's 20% in 10 years. But if you're going that 2% per annum, you're going to offset it in 5 years. If you can get another in 5 years to offset, that means you're going to pay only 10% instead of 20% in 10 years. In 10 years is 20%, you got 2% per annum. I'm assuming 2% per annum. In 10 years, you're going to pay 20%. But in 5 years, you're only going to pay 10%. So the longer the term, the more the interest rates. So that being said, now we need to know whether that money can offset the debt owed. Three, we need to know whether it is bankable enough to ensure that the price level, because the money you're going to use will depend on the price level. If oil price, like today, oil price is about 60 something dollars. So you won't expect to make much money as if it is 80, $90. So when the oil price rise to above 75 to $80, companies will make more money. That's the simple truth. So at that price level, is it bankable or not? So this objective is what we're going to discuss today. So let's see exactly how we'll start with the first one, which is what cost allocation. So cost allocation is a process of identifying, aggregating, and assigning costs of oil and gas exploration and what production activity. So you identify your cost. What any amount of money you spend, you must identify that cost. You must label it properly. It's important. If you mislabel your costs, you may end up making a mess of the whole system because you must understand which cost you spend. So you must understand which cost is it operating expense, is it capital expense, is it deductible. You must label it properly. What's the purpose? The primary purpose of cost allocation is for financial reporting, and the purpose is what? For tax compliance and what? Regulations. No, normally there's a time government said this 10 barrel per barrel production that companies will spend operating cost should be $10 per barrel. That excludes capital expenses. Obviously, government wants you to invest more in capital expenses, but they want you to cut down your operating expenses. Let it be below somewhere $10 per barrel. We know it's not possible under operating caution, but at least that's an idea of government at that time. Around 2020, they said, oh, companies should do 10, and they gave tax incentives. The lower your production cost, the more you get tax incentive. And they did that at that particular time, 2019, 2020. That was what it happened at that point in time. So if you actually allocate your operating costs separately from your capex, you see that whether you meet that requirement or not. But if you mix your capex in that thing, it will be more than $10 per barrel. So what are the type of cost allocation? As I said, it can be a capex or it can be what? OPEX. Why capex is amortized over 5 years? Because see the difference here. If you have a capital expenditure is usually amortized for 5 years. So you're going to recover that capital expenditure for 5 years, and even you're going to leave 1%. So if you spend $100 as a capital expenditure, you're going to recover only $99, leaving 1%, $1 behind. You can't recover that $1. But if it is operating expenses, you recover them in that same year you put in that money, not next year. That same year you can recover your fund if it is deductible under tax. So if you watch this thing now, if it's deductible under tax, you even deduct it before you even pay tax. You subtract it from your revenue before you pay tax. So that means it lowers the tax you're going to pay. So expenses are recovered fully in that year. Again, some OPEX are deductible, some are not deductible. So let's go and look at this thing, the classification in a simple form. You see, your cost can be CAPEX or OPEX. If it's CAPEX is grouped into 5 basic sections in law: drilling expenditure, pipeline and storage expenditure, there's plant expenditure, there's building expenditure, and there's pre-production expenditure. While OPEX can be administrative or production expenditure, it can also be fixed and variable expenditure, depending on how you want to classify it. So you must know how you want to classify this thing. If you want to classify as fixed and variable, fine, but you must be able to understand which one belong to fixed variables and which one belong to fixed OPEX and which one is variable OPEX. You must understand which is which, or which one is administrative OPEX and which one is productive or production OPEX. So you must know which one is which. And your CAPEX, you must know which one is drilling expenditure, pipeline and storage, plant and building. You must know which one is pre-production expenditure because they are handled separately. Now, look at drilling expenditure. You know, drilling expenditure are tangible and intangible drilling incurred directly in connection to what? Making the well. Once you make a borehole, that cost incurred in making that borehole or even doing some workover, they are all drilling expenditure. So cost of workover, if you do a workover expenses, that workover should be grouped as what? As a capex. It is not an opex because e involve drilling. Once you involve rigging, it's a drilling process. So you must understand that this is what is a drilling expenses and is a capex. And so I've listed some of them, both tangible and intangible expenditure. Is just for you to look at it. It's not something I waste my time. So another one is pipeline and storage expenditure. The pipeline and storage expenditure are the things are like the storage are like gas handling facilities, the oil handling facilities, the water handling facility, and the pipeline. So the storage facilities, look at them as like FPSOs, all those things are pipeline storage facilities. They are pipeline and storage facilities or any pipeline. Pipeline is defined. Pipelines are capex or all those your water handling, gas handling, oil handling, FPSO, MOPU, all of these things are classified as what? Pipeline and storage facilities. So there is plant and building. You have your plant, your building, not building is normal, any structure. So plants are expenditures incurred in machineries. Like now, if you're in a platform, in that platform there are generators there. The generator you have in the platform that fire this thing is a plant expenditure. The cost incurred is a plant expenditure. No, and then there's something happen here. Some of these capex, if you rent them, they are no more capex, they now turn from capex to opex. So some companies will come FPSO, they will rent FPSO. The cost of rent is not a capital expenditure, but about operating expenditure. So you must know that all these capital expenditure, once they are rented, a building, if you rent a building, it's not you didn't build the house, it's a rent. So that become part of the rent you're going to become a operating expenses. Even if it is plant, you rent that plant, it becomes part of what? Operating expenses. So if companies can barely rent everything they want to use, they make sure that they don't have capital expenses and it does government may not allow you to do so to rent almost everything. The government will not allow you to do so. They will ask you to acquire because investing in capital expenditure has to improve the financial the social development of the company of the country or even the company too. So now we have what we call pre-production expenditures like G&G, geological and because all G&G exploration and production, all those things are G&G exploration and production activity. Then you have not produced even a dime. All the expenses you make before you produce one drop of oil, what we call pre-production expenses, as the name implies, pre-production before you try to even produce one drop of oil. Remember, if you start your business, I start my oil company today. I've not produced one thing. I'm going into exploration today, and I have about 10 years or 6 years if it is onshore, 10 years for shallow water and deep offshore. And that within that time I have, I was only doing exploration and production. I won't pay tax because I've not recovered. You can't pay tax when you have not made money. It's when you have made money you pay tax. You can file, but your filing is zero tax. The law is that you will file your tax. Filing does not mean you've paid anything because you've not made any profit. So you just file your tax that to show you are in business. Do you understand? You file your tax. However, when you start making money, is when you start paying your tax. Now when you pay money, royalty, tax, all those things. So you spend money before then. All the money you spend before you start producing is what we call what pre-production expenditures. And like the GRG, signature bonus, like other renewal bonuses, all those. Okay, Renewal he has gone. He started producing before you do renewal bonus. So, but pre-production signature bonus is but you pay before you even start producing. When you sign your contract, you pay signature bonus and other capex and opex again that can be incurred. If you check all those things again, you now check which one is one. Other expenses incurred before you start producing, that all called what? Pre-production expenditures. They are also regarded as what? As capex. So you book them, move them all to the year you start producing, and then amortize them from that year down 5 years and recover them as a capex. However, under PIA, signature bonus is no more recoverable, it's no more deductible under tax, so you can't deduct it. If you have signature bonus, they will say no, you can't deduct it, you can't recover it, it's not there. So that's it. Notice that difference. But before now, it used to be together, you amortize all together. Another way to allocate OPEX is what? I said it, administrative and what? Administrative and the production expenses. I've listed some of them here. It's not something with just a list. So you can look at it. The list here is not, it should not be accepted straight ahead. So you must look at it carefully. This is my own list here. You can have your list. All accountants have their list or have their locating, which is productive and administrative, which one is what production expenditure. Now, there is also a way to locate which is deduction allowed under law and which deduction not allowed. This one is not negotiable because it's law and listed there from law, section 256 of PIA and section 254 of PIA, 263 and 264 of PIA. Deduction allowed and not allowed under PIA. And I went under section 10 and 13 of PPTA and also listed them from there. So if you see all these ones listed here, the ones allowed and the ones not allowed. You must know the ones allowed and the ones not allowed. Why do I say so? Normally, as an accountant in the company, the tax per account, that's the profit before tax. That's the tax you calculated your account. Is simply all your revenue minus your operating expenses. That's what you do. So accountant does not even bother whether it is deductible or not deductible. So what he does is all the revenue I've made, all the money I've made, minus the operating expenses. He calls that profit per account. That's profit he has in your audited account, or profit before tax, as the case might be. But when he goes to pay tax, the tax man will look at his audited account and say, this one you write here is not deductible. Add it back again to that profit. All the non-deductibles will be added back to profit. You now pay tax on them. Do you understand? Because you remove them, you have to add it back again. Remember, the accountant never bothered. All he did was all the operating expenses, he just pulled them out. All the operating expenses, he pulled them out from the revenue. The tax man will say, okay, let's go back and check your account. This thing now, this item, let's say bank charges. You should add it back. Any amount, if it is $10, add it back again to that profit you calculated. You understand? So you now have your what to call accessible profit. That's how to get that this thing. And that's how the company how they goes ahead to get that this thing. So that's why you must understand which one is deductible and which one is not deductible. Now there are conflicting deductions that seems conflicting, like foreign exchange losses, central bank commission, scholarship expenses, gift and donations. Those deductions under the profit tax, they are deduction allowed. And this issue rose in a matter between Shell Nigeria Limited and FRF, those days used to call it the Federal Bureau of Internal Revenue, something like that. So this case in 1996, this case, the Supreme Court held that all these charges I've mentioned, that deductible. You know what happened? Because Shell at that time added this and removed it from SPES before they pay tax. FRA say no, you can't remove them. You must add them back and pay tax on them. Shell sued them to court, and the court found that the Shell was right. Again, happened in a Gulf Oil Company Nigeria Limited, and the same thing. This one was 1997 case, and they found that those charges are what deductible under law. However, under PIA, they are now non-deductibles. Exchange losses, central bank commission, scholarship expenses, gift and donations, they are not deductible. So if you have those, if you have made expense on those items now, once FRS sees them, they will add it back for you to pay tax. So you can't deduct them, you add them back to pay tax. So there are other fees. I can't waste my time, but I copied the fees from Regulation 2022. These are the fees you can pay, like application for petroleum exploration license, $5,000, application for renewal, $4,000, all those things. So if you might have made expenses now, take for instance, if you're an accountant, you say you want to pay for something, look at the list. They have the list here. How much am I paying? You pay that same amount. You record, I pay this amount for this thing now. Request for this, you pay, renewal for you pay, and then extended text, you see it's $10,000. You pay the amount and record it in your book. So you must be able to record exactly what you paid in the area they fit inside. Their rents. You can pay rent for production platforms. You can pay rent for oil handling facilities. You can say before, you can build them or you can rent them. You can pay rent on them. So renting fees for all those things are listed here. $2,000, all those things that are listed here per annum. So the applicable rent again you can pay. You see all of them here. There's renewal bonuses is here. You see the amount to pay. It's under section 8 of the PIA, section 87 of PIA. You see the amount to be paid for renewal bonus. So Now, royalty. This one is another piece again that is very, very important to understand. Royalty is not just number. Don't assume it. You pay based on what? Production. Any amount of oil you produce to sell, you're going to pay tax on royalty on it. Or any gas you produce to sell, you must pay royalty on that sale. So if a gas is flared, you can't pay royalty on a flared gas. You can't pay royalty on a gas you use to run your plant. It's only gas you are going to sell that you pay tax royalty on. Or oil you are going to sell, you could pay tax on it. Or condensate you are supposed to sell, or natural gas liquid you are supposed to sell. So you are paying royalty on crude oil, natural gas, whether AG or this one, you pay AG and AG. You pay royalty on condensate, you pay royalty on gas liquid. So the royalty is always paid on what? On volume. As a volume. So if you sell the amount of volume, the volume is sold. So you do a fraction of it. So now royalty rate times what? Revenue. While revenue is what? Production times physical price. And now let's go royalty rates. Under PIA for gas royalty is 5% for export, 2.5 for domestic use. If you export that gas, you pay 5% for export and 2.5% for domestic use. But for oil has two kind of royalty: production royalty and price royalty. Production royalty for onshore, you are going to pay if you are producing less than 10,000 barrels per day, you are going to pay the first 5,000 barrels, you pay 5%. The next 5,000 you pay 7.5%. And if you are producing above 10,000, the remaining fraction of it you are going to pay 15%. Example I made here, let's say you are producing 4,000 barrels per day, your royalty rate is 5%. If you are producing 8,000 barrels per day, the first 5,000 you are going to pay 5%. The remaining 3,000 you are going to pay 7.5%. That's what you see here. See, 5 times 5,000 plus 7.5 times 8,000 minus 5,000, which is 3,000. Now, because you weigh it on 8,000 divided by the whole 8,000, that will give you 5.95%. If you are producing 13,000, the first 5,000 is 5%. The next 5,000 is 75%. The remaining one after 10,000, which is 3,000 again, is 15%. Remember, it's 13 barrel per day divided by 13. If you do that, if you're producing 13 barrel per day, your royalty rate is what? 8.27%. That's your royalty for that 13,000 barrel per day. Someone who is producing 8,000 barrel is paying 5.94%. This is what we call sliding scale. It's on a sliding scale. So the same thing happen for onshore, for shallow water, then for deep offshore. Frontier is single. If you are producing frontier like Anambra Basin, all those things, royalty there is 7.5%. This is production royalty based on production. So now price royalty. Price royalty, if the price of oil is below 5,000 $50, you pay no price royalty. If it is $100, you are going to pay 5%. If it's $150, you're going to pay 10%. If it's in between, you interpolate. However, when you interpolate, know that you are going to escalate it by what? 2%, relative 2%. That's why if you see here, the first year, I did example here, 2023, the first year the lower band price is $50, the upper band is what? 150, the middle price is 100. If you escalate this in by 2%, in 2024, you're going to pay $51 for lower band, upper band will be $53 for 2025. So it continue escalating to 2% like that. So at every point, you can interpolate within that lower band, upper band, and the interpolation formula is what? 10 divided by upper band price minus lower band price into price minus lower band price. With this, you can always get your price royalty. So when you calculate price royalty for price royalty, production royalty, add it together, give you total oil royalty. That's exactly what you're going to do. Under PPTA, this is actually different. You see, for onshore, 20% is fixed. It's not sliding scale. It's fixed because for onshore it's 20%, for deep water, so it's related to depth. to depth of water, 2018 just to zero. If it is 1000 depth, beyond 1000 water depth, you pay. That is ultra depth, deep, far deep ocean. You understand? That's why you pay no tax, you pay no royalty. So now for gas royalty, it is 7% for onshore and 5% for offshore. The same thing happen again. This is for JV and sole risk. For PSC, it is also a different scale for PSC. So for PPTA, the royalty for JV is different, for royalty for sole risk is different, for royalty for what? For PSC. So you know the royalty, you can come here, pick them and go on and move on there. The same thing again for under PPTA in 20 PSC under in 2019 modified PSC, then they now change this thing now for deep offshore. For deep offshore, this is the PSC for deep offshore you are going to pay. This is PSC for marginal field. This is marginal field. This is the royalty for marginal field then. So for deep offshore, you are going to have this royalty. It has price royalty and production royalty for deep offshore. But for marginal field, this is the royalty you are going to pay at this scale now. This is section 2.1 of marginal field operation physical regime of 2005. Now, another fee you are going to pay is NDDC levy. NDDC levy is 3% of your annual budget. Annual budget of the company is 3%. The NDDC levy is 3%. So you must be able to calculate NDDC, but you must pay NDDC levy. So you must know how much levy you. So you do your budget, do 3% of the budget. That will give you NDDC levy you are going to pay. And now there's host community. Host community is 3% of operating expenses. Actual operating expenses, that is your host community fund. You pay that host community fund. You also pay the commissioning. The commissioning is actually a yearly contribution. So normally you get your whole asset price. This is my asset. If my asset is let's say $100 million, my asset investment is $100 million. I can say, okay, let's check between 5 and 10%. How much will it take me to the commission this thing? It may take me between 5%. Let's say take 5%. That means what 5% is actually how many? 5 million. 5 million USD, that's 5%. And if the lifespan of my field is 20 years, I divide that 5 million by 20 years, each year I'm going to contribute that amount, that 5 million to that amount, that equal amount for the thing. Every 10 years I'm bound to renew to check whether if what I'm contributing is too small, I can increase. NPRC will come to me and say, I've checked what you're contributing is too small, it cannot cover your what they call it, the commercial abandonment at the end of the 20 years. You ask it to increase, or if it is too much, it can decrease after 10 years. It's subject to review after 10 years. After 10 years. So there's natural gas flare. If you flare gas, you're going to pay penalty. Before that used to be $2. If you're producing 10,000 above 10,000 barrel per day, you pay $2. If you're producing less, you pay 50 cents, 0.5. But now they made it the law has changed. Before it used to be if you're producing $5,000, you pay 2. Now since it is under this rule, it's $3.5. So it's changing. And the question again is this: I'm asking a question. NPRC does not have just right to change the gas flare penalty at will like that, because this should be by regulation or by law. You get but oftentimes they change that this thing without having enacted a regulation to cover that change they have made. That is not legal. So I think that most companies should question this. They should pay this thing based on the regulation they can find, not when NPRC will come to me and say gas flare penalty is $3.5 per thousand, 10,000 barrel or 5,000. It shouldn't be so. It should be something written in a law that is gazetted, that they have a regulation. If that regulation is not gazetted, it's not regulation. So every regulation shall be gazetted. That means it passed through the process of making law, of making regulation. So it must be gazetted. So if it's not gazetted, you should not be paying such amount of money. So that point here. So it now currently what I know currently it is what? It is $2 if you're producing above 5,000 barrel per day. But some said some said it is 3.5. NPRC has said $3.5. But I think that is not legal, because I have not seen any law. Nobody has showed me any law that gazetted that say it is $3.5 per barrel. They are just saying that companies are paying that amount of money, flaring gas are paying that amount of money. So after you are able to organize your cost, the next thing again, you calculate your tax. This is where most economists have issues. Most economists in oil and gas industry have issues here. They compute tax based on assumptions. There's nothing you are going to assume here. Everything is written by law. You must compute tax the way the law says you should compute the tax. Gradual process, compute it exactly. Because this is not rocket science. If you make assumption and compute your tax the way you want to compute it, it won't be correct. And tax constitutes at least 30% of the revenue. Your tax constitute at least 30% of revenue. If you compute the wrong tax, that means that everything you're going to, unless you're going to do otherwise, will be wrong. Because everything depends on tax you compute. So in essence, most of us who do economics in petroleum industry, we must compute tax, exact that FRS should compute, whatever that person should compute, exactly. Not making assumption, we make assumption, we compute, we say okay, let's assume tax this way, assume this thing, we compute whatever. No, it shouldn't be so. We must compute that tax based on sequence and order, the way it is arranged. There's certain order of arrangement because it's important you know what and what to compare at every step. So what we'll do is simply subtract the expenses and then apply a tax rate. It shouldn't be so. We must follow the same order of how to do capital allowance, production allowance, all those things gradually and get to your chargeable profits. So we must follow that rule effectively because it's by so now all this taxing position you cannot, what I'm saying here, you cannot pay tax that is not by law. Every tax has a law backing it up. So that is why you competing as economist, you must follow the law. Take the law and follow exactly what the law has said you must pay and pay exactly that amount. Don't over calculate, don't under calculate. Let it be exactly what the tax law has said you should pay. So under the PIA, look at tax under PIA and PPTA. Under PIA, you're going to pay hydrocarbon tax. Under PIA, you're going to pay income tax for oil. You're also going to pay income tax for gas. See the tax you're going to pay for under PIA. Three kinds of tax. You have pay hydrocarbon tax for oil, you pay company income tax for oil, you also pay gas tax for gas. But under PPTA, you only pay petroleum profit tax for oil and then income tax for gas. So you must compute these taxes separately and in order the way all of them was computed separately. And when you finish, if you pick PIA, you join all the tax, that's the total tax. So some will compute only hydrocarbon tax and leave company income tax. It's not the total answer. The total answer is the under PIA, total tax must be hydrocarbon tax plus company income tax for oil plus company income tax for gas. If you do not sell gas, fine, you forget company income tax for gas. But if you sold gas, you must compute company income tax for gas. Now, okay, let's move on. Now, what are the tax rates under PPTA? The tax rate under PPTA under hydrocarbon tax rates. Now, for PML, it is 30% for shallow water and on onshore and zero for deep offshore. So you do not pay hydrocarbon tax for deep offshore. It's an incentive for people to operate deep offshore because when you're deep offshore, you are not going to you no tax for deep offshore. But if you are doing if you have a PPL, that is petroleum prospecting license, or if you have marginal field, it is 15% for both onshore and shallow water, and also zero for deep offshore. You're not going to pay. So deep offshore, you're not going to pay tax. But if you have PML, you're going to pay 30%. If you have PPL, you're going to pay 15% for both onshore and shallow water. For petroleum profit tax, it is 85% of chargeable profit for the first 5 years. For the first 5 years, you're going to pay 65.75% for the first 5 years. After the first 5 years, you're going to be paying 85%. So because they give you that leverage, say okay, you let your tax for the first 5 years be what? Be 65.75%, but after 5 years, you're going to pay 85% of chargeable profit. However, for PSC, deep offshore PSC, the tax is what? 50% flat. Remember that some people are still operating under old regime today. They've not converted their license. So those people still compute their tax based on, if somebody has not converted his fuel asset, he's still paying tax under the Petroleum Profit Tax Act, not under the PIA. So you must understand that you're going to use this rate and not the PIA rate. So that's why you must know when I read economics, the economics, you must know whether it is PPTA or PIA. And if it's PIA, you must know whether the PIA is a new lease. New leases are those ones you acquire from August 16, 2021. Any asset you acquire after August 16, 2021 is what we call new lease. They have a different structure. The structure very solely what production allowance I will show you. So How does it go to compute your tax? The first thing you compute is what? You get your tax is computed what? Charge on what? An assessed on chargeable profits. You can only compute this thing based on chargeable profit and item related to upstream operations and during accounting period. So the accounting period for Nigeria is 1st of January to 31st of December each year. That's accounting period for Nigeria. And that accounting period has been used and it must be in dollar. So what are the calculation procedure? One is what? You first get your adjusted profits. Adjusted profit is your revenue minus. Remember, before now, what you have is profit per account. Before we get here, what you had was profit per account. That is your profit, your revenue minus all the expenses, OPEX you've incurred. So to adjust, you now adjust that profit. You adjust that profit by removing all those, adding back the deductions. You add back those deductions, those non-deductibles, you add it back. So you have what we call adjusted profit. Or you can say it's simply revenue minus the deductible ones. Revenue minus all the deductibles. That will give you adjusted profit, or your profit per account plus addition plus adjusted all the non-deductibles. After that, you now compute your assessable profit, which is adjusted profit minus loss. The loss you incur per year. If you incur a loss, because if you incur a loss, you have to remove that loss incurred from your adjusted profit to get your assessable profit. And each of them, you see the loss where I took them from the loss. This is where the loss said wrote those things down. So if deduction on loss from adjusted profit cannot be made, that's where you cannot remove the loss. It means you carry that loss over again. You carry the loss over. Like if you cannot remove the loss, if you remove the loss, means that assessed profit is negative. At the point where the assessed profit become negative, means you cannot remove your loss. In that case, you carry the loss over again. You carry it over. So after you calculate that one, you now go to calculate your chargeable profit. Chargeable profit should be what? Asset profit minus capital allowance and production allowance. So you now compute your capital allowance, compute your production allowance, then you now do your chargeable profit. You get chargeable profit. And when you get chargeable profit, there's something again, you do minimum tax. That's not here. You check minimum tax. Minimum tax now is 35% of your revenue. 35%. That's minimum tax under PIA. For other PPT, okay, that will discuss that later, sha. You check minimum tax. Which one is bigger is what you are going to select. So you now pay what we call hydrocarbon tax percentage. That rate, 30%, you apply it to charge profit and pay your tax. That's the procedure. You don't circle this procedure. This procedure must be finished. And inside this procedure, there are many things happening there. It's not expanded. I just made it just a general thing. There are many things happening inside that procedure that is very complex. It's not just as straightforward as I listed here. So you must follow those things logically and get your tax correctly before you can proceed. So now, how do you get? Because what you see is revenue and all those chargeable. So let's couple this back again. Revenue is simply what? Your production times what? Times price. That's how you compute your revenue. Component of oil revenue. So it's now, but revenue can be that the one you export, the one you expect you sell it in dollars. The one locally you may sell them in naira. That's why Dangote was saying that they should sell crude to him in Nigeria, because the law require that if you sell that crude oil within Nigeria, you can sell them in naira. Do you understand? You can sell them in naira because it's transaction in naira. It's even an offense for you to operate in dollar, to sell something in Nigeria in naira, in dollar. It's even an offense. However, the PIA said that the tax we must file in PIA must in this thing must be what? In dollars. It must be in dollars. So you check this whether you've actually exported or you've sold it locally. Now, and the essence is that it is the buy times price that calculate the revenue. So chargeable revenue. Now, there's another thing again you have to compute, because assessable profit, you have to compute what? Education tax. Once you get your assessable profit, you now do education tax. Education tax before 2019, it used to be 2%. At 2020 it was 2.5%, but in 2020, because of COVID-19, they said if you're a small company you will no pay education tax if you're a small company in 2020. However, no oil company is a small company, because small company you must have at that time, you must have revenue less than 25 million naira. 25 million naira is just few change in dollars. So no oil company is a small company. So forget the small company own. So oil company must pay must pay the education tax. Between 2021 and 2022, it's 2.5. Now, between 2023 and 2024, it now got to 3%. Now, and 20, after 2025, after next year, and after this year now, from next year 2025, from 2026 now, from 2026 onwards, we are going to have education tax at what, 4%. It won't be 3% anymore, it will be 4%. So when you are computing education tax, you must know the actual rate to apply by checking the year. And some of us will just do year one, year two, year three, year four, year five, year six. If you do, when I see people do economy year one, year two, year three, year four, year five, year six, it will not work, because every tax you are going to pay depend on particular year. It will differ. So if I don't know the year you are talking about, how do I know that this year is a leap year or ordinary year? Because the volume you are going to multiply 365 or 366 days or 365 days will differ. The answer will differ, in at least the revenue will differ by that one day gap. I remember in production, we do production based on what? Our rate will be based on production days, but accounting people will always consider the full year from January to December 31st. So it is not their business. So you must understand these things effectively. You must know exactly which you are paying tax, which you are not paying tax on. It's important to notice so. So how do you assess your capital allowance? So capital allowance, I said before now, that those capex I mentioned now, so they are called what we call qualified capital expenditure, which means like qualify plant expenditure, qualify pipeline and storage expenditure, qualify building, qualify drilling expenditure, qualify all those things, you now call them qualified. Now there is something important you will not do. If you amortize all those process expenditures now, process expenditures, you cannot amortize, you cannot amortize them, but when you do depreciation, because they are not physical assets, you cannot depreciate them. They are two different things. If it's not a physical asset, it cannot depreciate not a physical asset. That's why once you group something to pre-qualified expenditure, it cannot, depreciation will no more be there again, because you group them into pre-production now. It's assumed that it is not a physical thing, like intangible drilling. And that's why some people say bring out intangible drilling so that you will know the one you are going to depreciate, the one you are going to depreciate. Is important. So, and now, as I said, the capital allowance is 20% for the first 4 years and 90% for the fifth year. That's a simple scenario. Now, okay, this is just making expenses. So the qualified junior expenditure, qualifying, blah blah. Okay, tax imputation, signature bonus. Now, after you do your qualified tax imputation, you now do production allowance. And so you have your capital allowance, you now have your production allowance. Your total allowance, capital relief, capital capex relief you have is capital allowance plus production allowance. That's the total relief you have. So you compute this one. If it is any OML, that is OML means before you start even before PIA, pre-PIA. This is is $2 per barrel, $2.5 per barrel, or and 20% of what? Physical price. Which one is lower? You choose that one. That's how much the rate you need to pay. Or if the new lease, that's the lease you formed before now. Those ones it should be PML. That's for PML. This is the scenario. If it is $50, this is just the rate. It's not something I have to, it's just the rate. So the other PPTA, capital allowance will remain the same. It's not changed. But we now have what we call investment allowance. Investment allowance is 5% for onshore, 10% if it is 100 meter, then 15%. It's graded with depth. That investment allowance is graded with what? Depth, if you're working under PTA. So now there are restrictions, what we call restrictions under PIE and PPTA. The obvious objective of restriction is for tax purpose, so that the government will make sure that it cannot, because if you leave some people they will remove everything and pay almost zero tax. It is not tax evasion, it is tax avoidance. I can remove things carefully, remove things here, at the end of it they see me pay almost no tax. Government say, oh, accountant can be tricky, trying they want to trick us. Okay, let's put restriction on this days now. Let's put it so that before you know it, if you say you won't pay tax, you end up paying certain amount of tax. That's what government did now. They put the restrictions so that if you remove as you want to remove everything. When you remove finish, you get to certain level, they say, okay, since your tax is this level, Now you cannot pay below this level. So they put that restriction. The chargeable profit shall be determined such that the allowance equals to capital allowance plus provision allowance such that chargeable profit equals to accessory profit minus allowances, or which is more. They say, okay, if you do your accessory profit minus those allowances, or you do chargeable profit based on cost price ratio. Now, based on cost price ratio, which is more? So you see your chargeable profit, now you're selecting two chargeable profits here. So which is more? So that the other one you did, the first one you did, which is acceptable as allowance, if you don't remove allowance, everything become low. It's okay, finish. Redo it again by doing chargeable based on what? Cost price ratio. If you do it based on cost price ratio, which one is more? You choose that one. So they restrict you from just running away with their small tax. Under PPTA, it is usually capital allowance equals to what? Annual allowance plus investment allowance. Or you now say capital allowance equals to 85% of accessory profit minus 170% of investment allowance. Which one is less? So you choose from there. So under PPTA, you restrain to choose two classes. You choose the between the lower part of it, you choose which one and pay tax on it. That one you are going to pay tax on. Now, after that, you still have what they call again minimum tax. After restraining you, they say, okay, we still say, okay, if after doing those things, you feel that you want to cheat us again too, let us put your tax like this. You cannot pay this below this tax. They put a limit. So this will call minimum tax. Minimum tax is the minimum tax you are going to pay. After you complete all those things finish, and if it's still less than a certain amount, they say, no, you won't pay that. Pay your minimum tax. And minimum tax under price cost price ratio is 65% of gross revenue. So of which ratio price ratio of 65% of gross revenue. So you do it when you check all those things, it will amount to about 35%. In the case of PSC is 30%. For under PPT is 15% of tax, shall not be 15% of tax which should be chargeable to a company. So if you do your chargeable profit, you do 15% of it. If it is, that's your minimum tax you're going to pay. It must not be less than 15%. So it must not be less than 15%. So it must be at least 15% of that amount. So if what you said before, campaign before, after restriction is more than 15%, you take that one. But if it's less than 15%, you pay that 15%. So it must not go below 15% of your this thing. That's what it means. So you remember again we said you can pay tax on oil. What you pay on oil is what? Is CIT. Under PI, you pay CIT on oil. So this is a process. The process is almost the same thing again, but now different scenario, different competition process. The competition process are not exactly the same. Allowances are not the same, but you must follow them again and complete CIT based on that. So look at what is deducted, what is allowed and what is not allowed under CIT. I've listed them here. What is allowed and what is not allowed under CIT. Look at it and PIA. So now, when you're doing CIT, you encounter balancing charge and balancing allowance. Balancing charges, if I have an asset and I sell that asset, I made profit when I sell that asset, abi? If I have an asset, I'm using an asset, maybe I have a generator. I don't like that generator again, so I want to sell generator now and buy new one. I sell that generator now, I make profit when I sell the generator. If I make profit, I will pay tax on that profit I made in selling that generator now, because an asset I dispose of an asset, I have to pay tax on that generator I made profit on. But if I sell that generator and I did not make profit, I lost. I sold that generator and I made a loss. That loss, I will remove it from my revenue before I pay tax. You see how it is. So you must know when you have sold an asset, whether you made a profit or you did not make a profit. So if you make profit, remember you are going to add pay tax on it. You are going to add it to your chargeable profit and pay tax. But if you've lost, if you sold that asset and you made a loss, in that case, you are actually going to remove it before you pay tax. That loss, deduct that tax before you pay loss pay tax. And look at the constitutional procedure of this thing now. You have your additions, you have the depreciation rate, you have disposal, you have opening balance, you have your closing balance, yearly depreciation, cumulative depreciation, you calculate your book value. From there, you now calculate your balancing charge or balancing allowance. You can whichever, if it's positive, it is balancing charge. If it's negative, it's what? Balancing allowance. So you calculate that, and then that is what you have. So this is how you build your schedule. This is what we call what your capex schedule. You build it and keep. Now, that same tax, you pay CIT on gas. We said before now, you pay CIT on gas. Now, the question is what? Is it associated or not associated gas now? Because if it's associated gas, the way you manage your associated gas is different from your because associated gas you produce it with oil. The capex that will link all the capital expenses, the gas handling expenses go with oil. If you enter, if associated gas now, is the gas, and that gas is a byproduct. So what that means that you've taken all the gas handling facilities, all the gas handling things you've done, you've entered them as oil. You're not going to enter them again as what? Gas. You get my point here? So now, but if it's non-associated gas, it's you spend money, you drill well, you do everything, you do handle. So all the capex will be will go to to NAG. All the expenses made, all the capex will go there and stay. So that's the point and the decision I have to make here, whether it is a NAG or it is AG. If it's AG, you don't need to bother about capex because all the capex has gone to oil before. So what you're going to remove is just simple OPEX. All the OPEX, simple OPEX you made in selling that gas, all the simple expenses you made in selling the gas, that's what you're going to remove before you pay tax. So now deduction allowance for gas. You look at all the deduction allowance because it's important for each of them. This deduction not allowed because you must know deduction not allowed each of them, so you know how to handle it. Now, handling capex. You see this one now. You see for for CIT for gas, your capex is initial investment and initial allowance and annual allowance. So first we remove the initial one, whatever is left you divide it to 25. For furniture and fittings, you remove 25. What is left you divide them by 20. That is 20 is 5 times, 5 places. For building you remove 15. What is left you divide them to 10 places. That's how you choose. And the same procedure for computing your asset, your accessible sorry, what they call capex schedule. The same process we had before is here: addition, initial allowance, unrecovered cost, annual allowance. So this is the process of computing this thing is here. You just look at it. So after this, you've done your tax, you compute your tax correctly. There you start now. When I finish my tax, now let's go to contract. What belongs to government, what belongs to me as a company? You do analysis. And there are different tax framework we have. We have JV, PSC, SORIX, service rates. So you must know which one is which. Under JV, the first thing you do is pay royalty. Remember, you can pay royalty before. That's why it's important you get the exact royalty. You pay royalty, you pay tax. What is left now is what we call equity oil. It's that equity oil we now share with government the way you agree. 60-40 or 55-45 or whatever percentage you agree with government in their contract, you share the what do you call it? You share the equity oil. Now let's look at example. Let's say this guy has made a hundred revenue is $100. Now there's a company side and there's government side of it. So 15% royalty he pays to government. Government will take $15. Now what is left is $85. Out of that $25 he pays tax oil $30. He pays 30 to government. So government is now having $15 plus $30 to government o. So what is left now is 85 minus 30, $55 is left. And the equity is 40-60. So means company has 40, government will take 60. So they will share the remaining $55 that is left. So that means that company will take $20, government will take $30. So that means government take will now be royalty plus tax plus 30 equity, which is $78. And company is taking what? $22. Now, let's say they spend something like $40 to produce that thing. Remember, because it's a JV, government contribute money and company will contribute money. And government will contribute 60% of this $40, which is $24. And oil company will contribute $16, which is 40% of the $40, $16. Now, the net cash flow for government will be $78 minus $24 will give you $54. While the net cash flow for the company will be $22 minus, which is $6. So actually, the company has made a gain of $6 and government has made a gain of what? $54. So what is showing is that if government can monitor JV properly, JV is a very good form because government will invest and make money. But because government does not invest and make money, what happens is government will now borrow. All these $54 will go into paying what? Interest. Because company will give you the money and collect interest from you. So and when you pay interest to service that debt, before you know it, you have made no profit. And that's why JV become a problem for Nigeria instead of a blessing, become a cost because of interest on the loan. It's find out that sometimes you pay interest and government will not get anything from the business again. So it is a problem. Now let's look at PSC. Under PSC, you simply again you pay royalty, after paying royalty, the company will recover their cost oil. After recovering cost oil, what is left they will pay tax. After paying tax, what is left now they share with government and their sharing formula. Let's look at that one again properly. Their sharing formula, the sharing formula you have is what? Cumulative production or R factor. So these things are different way. It just how much you produce, they are being shared. Look at the sharing formula. R factor says if it is less than 1.2, you pay government will company will take will take 70% of the share, but in between you interpolate. But it's above two. R factor is above $2.5. Government company will only take 25%. That's a simple logic. So look at interpolation factor I gave here. Cumulative production is what they have here. This one under PIA, look at it. Under new lease, look at it here. You have.
All nine. Yeah. So
So
what
look
I
at
would
the
do
look at
by the time.
hello hello. All right. So let's go on, please.
Yeah, just continue. Thank you.
No. Now the let's say we repeat same example we had there before under PSA now. $100 government royalty 15 goes to government. Now what is left $85. Company will take their cost oil, but cost oil is always ceiling. Under the PPTA it is 80% ceiling. It is 80% ceiling, but under PIA it is 70% or 65%. I forgot the exact percent ceiling now. So the ceiling is 80%. That means that what they can take from this place is 85. It cannot take more than $80. But luckily what they have left is $85. So even if company has spent $80, they can take their $80 entirely. So but let's say the company has spent only what they invested was what $40. Remember we spent $40 a day. So 85 minus 40, what is left is what $45 now. Out of that people, you remember you computed your tax. Your tax was $30, abi. You remove your $30 from this tax now. What is left is what $15. This $15 is what they're going to share based on any factor, either R factor or based on whatever you're going to share your this thing. They share again. But let's say the R factor yielded 60-40 again, profit share 60-40. That means government has 6, oil company has 9. If you oil company now will be $40 plus $9, which is $49. Government will be royalty plus tax plus share, which is what $51. You see what happened? But now government did not invest a dime, so the government cash flow is still $51 because they didn't invest anything. But company cash flow, because company invested money, they are going to do that $49 minus $40 they put in, which will give you also $9. So the cash flow for company is $9. The cash flow for government is what $51. The same thing happen for sole risk. So if you look at sole risk, the same sharing formula. Sole risk simply means pay tax and royalty. Nothing, everything you have is your own. That's what it means sole risk. So here government have a $100, pay royalty, pay tax. You are going to pay government 15 plus 30, which is 45. The remaining one belongs to the company. As simple as that. That's the sole risk process. Now, having discussed sole risk, let's look at contracts. Let's look at project evaluation analysis. Now, the basic plan is what you have. When you evaluate this thing, you have to decide which no further action, restoration, workover, drilling, whatever you want to do. Because if you do a restoration, a workover, you have to evaluate whether that project you did is viable or not. You can decide on what. So that's what I'm saying here. You can decide whichever one you want to do. You can do plugging, reperforation. If I do reperforation, I can say, okay, let's do economics and see reperforation economics, whether it's actually viable or not. Let us drill new well. Let us drill new well and see whether if you drill new well, what you produce from new well, whether it's viable or not. So you can do these things and then check yourself and know whether it is viable or not viable. So the basis is actually what we call capital budgeting. And now the example of capital budgeting, which is payback period, NPV, inherited return, profit index, and unit cost, and unit technical cost. These are the indicators we are going to use and all based on what capital budgeting. Now let's look at the first thing, cash flow indicators. Cash flow now, cash flow is simply your revenue minus the expenditures. You do that over time and goes on. So if I plot my cash flow here, this plot is important here because I plot NCF against time. So you see cumulative is going up like this. After some time it stabilizes. If it turns down, that means if it turns down, that means you started losing money again. So if you look at this, if at any point you plot your net cash flow and at a certain point it turns, because first it rise, now it stabilize. At any time that cumulative turn back again, that means you started losing money. At that point, you must check and reverse whatever is happening there to make sure production increase, because what happened there is important that production has either decreased or something. So you now plug this and check here. From here, anywhere it touches in, that's your payback period. You can locate that again. Many things can happen with this. You can use that. However, let's do payback period. You can locate it by graph by locating this point where intersect x-axis. So payback period is between the third year and fourth year, somewhere there, 3.5 from what I've drawn here. That's your payback period. But there's a method of calculating which is payback period before the cost recovery plus the remaining cost to recover divided by NCF at that cost. So look at the example I made here. So in this one, the period before cost recovery is 3 years, because look at your NCF now. If NCF negative 200 minus 150 minus 30, so the period before you recover is, so recover your cost, your what they call it, payback period between 3 years and 4 years is 3 point something years. So I know before then it is 3 years. What fraction? The fraction is a remaining recovery. The remaining recovery is 37, because what you have is what, 37. That's what you remain. You not recover 37. Divide by total NCF at that point 4. So you now do 37 divided by 4 plus 3. It will give you the give you NCF, which, sorry, payback period, which is 3.4 years. 3.41 years. That is your payback period. That's how to calculate it. So there are weakness and strength of all these things. So let's not waste our time here. Now there is what we call NPV. NPV simply means this net cash flow. Net cash flow divided by what is just is a present value. You are looking for present value of a net cash flow. That's your NPV. You understand? So look at the formula here, but sometimes you can calculate this thing using solve it. So here you're looking for, if you want to solve this thing now, you solve IRR, you solve this equation. So for you to find IRR, solve this equation where it is zero. When the NPV is zero, that's
Dr. Austin. I think we lost him. Can you guys hear me?
Yes, I can hear you.
Oof. Okay, I think we lost him. So we'll try to get him back.
so we have
Okay, okay.
profitability index.
Okay, sorry, Dr. Austin.
Hello?
Yes, can you hear us, sir?
Yes, yes.
Okay, sorry, we
I don't know,
lost
my
you.
screen again. Okay, yes, my network just drop off then. So, but
Okay.
I'm done. So I'm done. So let's not. I'll finish. In case any question, this is what we are.
So, okay, sorry. Can you help? Sorry, can you?
So we now have, yeah.
Okay,
Go ahead.
okay. I just wanted to
Hello,
just continue. You wanted to round up, so yeah.
hello. Can you hear me?
Yes, yes, yes.
Hello, you're saying something. Okay, I want to run up. Yes. So after that, you now complete your technical course. The technical course is capital OPEX over reserves. Just like that, you get your technical course over this thing.
Okay,
Then scenario
okay,
analysis. Here, this is important again. Project evaluation. You have to do scenario analysis here, because it's important to do scenario analysis. You now do worst case, best case, and base case scenario analysis. And also from there, you can do sensitivity, do your own Canada plot or spider plot, whatever plot you want to do, and then you conclude the whole analysis. This is a few example I did here. Everything I put everything here. The few example I production forecast. I didn't do that here, but start with production forecast. You have to forecast your production first. Then you now do all other calculation, royalty, tax, analysis, blah blah blah. Then you get to the end. So that is all I have for you now. Please, in case anything question, I'm here. I hope I didn't spend much time.
okay. Thank you. Can you hear us, sir?
Yes, I
Just to
can hear
confirm.
you.
Okay, perfect. So thank you very much. Lovely. It wasn't the timing was just good. Not a problem with the
Okay.
time at all. Yeah. So
Okay.
Thank you very much for the session. Really insightful, taking us through. Basically, you have tried to bring something that is really a lot to show to become really small. Um, so we are very appreciative of that. Um, we are going to go to the Q&A session now. Really, what we're trying to do here is we're trying to apply what we have learned here to the current program that we are on, which is the bootcamp. So we're going to open the floor
Okay.
to the participants to ask some questions, and then they would and then we'll proceed from there. But the first thing we're going to try to address is what happened during the glitch. So when you dropped off, you're trying to explain IRR for the participants. And so we don't know if you can give us a little rundown of that, and then we'll proceed with more questions from them. So
Okay.
while we're handling
Uh,
that, okay, sorry. Sorry.
IR is simply remember your MPV, your MPV shows is your net cash, present value of net cash flow. That's what NPV, I mean, the present value of your net cash flow. That's MPV. And so at zero, that's undiscounted MPV. If you didn't discount it at all, that's a maximum MPV you should spoke at undiscounted. I know, but non-discounted cannot be your this. The company has what we call discount factor determined by company, and the way I determine discount factor is by taking one standard deviation from IRR. So from IRR, I take a standard deviation from IRR. That gives me a probability of what the company discount factor. So one sense is that the undiscounted factor is the highest MPV you should have, and that's the highest profit you should ever make in that business. But that is not, we can never pick. So you choose a discount factor. Framework for working MPV should be based on the discount factor of the company. And the economics knows how to go about getting that this thing. And I can always get it from my IRR. I do a model, get myself, I tell the company, okay, look at what can you work within this range of your discount factor. Based on other conditions they have, the company can say, okay, I like this discount factor, I don't like this discount factor. That being said, we are looking at that point when the thing will break even. Look at IRR at the point of zero, abi. So if at that point, if your discount, if your IRR is less than your discount factor, do you understand? If it's less than your discount factor, it means you are accepting it, and that's at the point where NPV equal to zero. That's your IRR. That point when NPV equal to zero, and that's your operating point. That's the point you're going to operate. So don't operate above that point. If you operate above that point, that means that you make a lot of mistakes. So your discount, the company discount rate should always be less than your IRR. Because you must operate within that margin, within that discount factor. IRR is that is a IRR is the point when the company should operate. That's the one they will not go too off from their margin, and they will not go too away out of the inside their margin. So at that point, you understand the company will operate at that factor, at that below any discount rate, any discount below the IRR. That's where the company should operate with effectively without having the risk you are going to take. Imagine you are going. Instead of saying how much is am I going to take? How much risk? Do you understand? If somebody say, let's take a larger risk, let's take a smaller. So you quantify the amount of risk you are going to take within that envelope. So operate within that risk, a bit free risk zone, which is when IR is below your what? When your discount factor is below your IRR. I don't know if I made some sense here.
Yes. Thank you very much, sir, for that. Really important for us. Um, I believe we must have passed the message perfectly for us. Before, so I'm going to also open the floor to the participants for you guys to drop your questions. You can drop your questions on the chat box, or you can just indicate, raise your hands, and then I'll get you up to ask your questions. I believe that a couple of us might have questions to ask, and then we can round up the technical session for Monday. So if there are anybody with questions, just raise your hands and then we can continue.
Good evening.